The last 24 hours, Bitcoin has dropped $5,100 from peak to trough. It was sitting just a few K away from the all-time high price. So this is now the largest correction in the entire 35-day run up. Now, if we are to see a correction at this stage, there is still a lot of bullish evidence in the background with traditional finance. S&P 500 has continued to squeeze out the perma bears, breaking past 5,800 points overnight. Of course, with some of that news from Trump reaching a deal with China, or at least that's what he's telling us. And of course, the Chinese president will be telling his citizens something different. But we're seeing prices go higher here on the S&P, on the NASDAQ, and on the Dow Jones. Now, we've got a similar pattern playing out to what happened 5 years ago in COVID. So I've got a lot to cover in today's video, along with the US dollar also showing very similar signs to what has happened in all previous cycles once it had started to collapse. And on the back of that, some crypto data, also some great things coming across here with the liquidations and exchange volumes. So don't go anywhere, hit the like, subscribe to the channel if you are new. Links in the top of the video description for our free report going out in less than 12 hours. So get that absolutely free. You can always unsubscribe in the future. So hopefully you are subscribed now. Let's kick it off. We've got the traditional markets to cover here. S&P 500, really nice push higher. And as I said, closing above the 5,800 point level. But I first want to burn your eyeballs here with the white background just for a moment and take a look at some of the data from S&P 500 cycling from a 3-year high to a 30-day, less than 200-day average. So basically going from a high to a low pretty quickly underneath a very significant level being the 200-day average. Now on the green arrows that you see here, these are the times that the signal has worked in the favor of the bulls 12 months later. The red, of course, are the times that it didn't work out. Two notable ones, 2000 and 2008. That's the peak of the dot-com boom. That's the peak of the GFC, or pre-GFC collapse. And then the rest of these greens are all pretty good. The other reds that you see are back in 1920s and 1930s, so a long time ago, and also in late 50s, 69, 73. But in terms of the data, the bringing all of the points together, 12 months later, 73% chance that the S&P 500 is going to be closing higher. 6 months later from this signal, and the signal date, so you can measure 6 months from there, is the 7th of May, 2025. So 6 months later, basically a coin flip if it's going to be higher. So it's looking at roughly around November. But 12 months later, so looking out to May 2026, there is a 70% chance that the S&P 500 is going to be higher. Also, 3 months later from May, it's going to take us to August. 70% chance it's going to be higher. Same thing for 2 months later. So it'll be interesting to see whether that happens July, August, and then May of next year. And if it is higher, the average max gain in 12 months time should be about 14%. Now the 18-year cycle hasn't peaked yet. We're still in the final stage here. Winner's curse, 2 years up. This is the US house price and economic cycle, business cycle, still leading into this peak. So essentially, I'm not expecting anything to change here with the stock market collapsing from this point. Got further to go, and then we see the crash, the collapse, whatever might occur after 2026. So sometime around late 25, 26, we're expecting a peak in the US house prices and the economic cycle, basically the business cycle. After that point, looking for the correction. Just wanted to make that clear because sometimes people think that it's just going to run up to January 1st, 2026 and then basically collapse in 2026. I don't think that's the case and never has been the case. It's always looking at a peak and then a rounding off effect there. In terms of the stock market, maybe we'll see that rounding off take a couple of months. Maybe we'll see it peak and collapse like we did in 2000 or in 2020 with the COVID collapse. And speaking of the COVID collapse, we've got a very similar pattern playing out here. I thought it was important to highlight this because of the bounce out of this low, whether it's a dead cat bounce or a V-shaped recovery coming back to new fresh highs. This latest 24 hours is really swinging it in the probabilities that it's going to be a V-shaped recovery because we've broken back past the key lower high before the collapse in April. So that was on the 25th of March. Now, the other thing that we have been watching was a potential pullback to roughly this zone, so around 53 to 5,400 points because of the lowering volume. However, there was also the chance, and as there always is, part of my up, down, sideways crew, is the market repeating something similar to the COVID collapse. So through COVID, the market did bounce pretty hard. And this is all going to come into effect, or it's going to be useful for us with the next corrections later in the year, because after we've seen a pretty severe correction, something really hard and fast, it's unlikely that you would then see another hard and fast correction to take out that low. And essentially what the market likes to do is take a little time to consolidate the move. Yes, there'll be corrections, but the consolidation is relatively shallow because you've already seen a pretty deep, severe correction. So it's essentially wiped out a lot of the buyers. Sellers have stepped in at the lows, and then that's pushed the prices up. So in terms of the volume, that did continue to drop off through the first rally and then started to pick up through the second and the third rally after these consolidations and these lows. So you can see this rally here, that picked up in volume, and then the next rally also had a few areas where it picked up in volume as it was breaking out. You had the correction again, but that landed at higher lows on pretty extreme volume. So you can see the volume stepping back in to support the market, and then it continued to climb again. So with that in mind, now we cast our eye to today's action. And this red line here is the COVID top to the dump. Just looking at a fractal here. And it's relatively similar. Pinning it to the lows, you can see some pretty severe corrections into this zone, a little bit of a bounce, then basically all the way into the low, the higher low there. So if we turn this off, you can see where that red line ends up. And the correction was in a similar timing here. Again, the move higher into a similar low. We're up into this stage now, basically a day or two out from this peak before it started to grind sideways for roughly 2 to 3 weeks. 4 weeks takes you out to the next move where it broke out of that consolidation. And then by the time you get to the end of the next month, somewhere around June, which is what we're looking at, that's where you get that next peak and the correction again. That is similar to what's happening with the NASDAQ. So again, you can see the fractal from the COVID dump. Here it is, and overlaid to the current market data. It's a similar sort of trend, a bounce out, similar timing, a correction into a higher low, similar timing, a move higher, similar timing, again, a small correction, similar timing. And then here we find ourselves in the next couple of days, could be another pop and back into this zone again for another basically higher low, similar style correction. Now, I had been looking at the volume and where this was starting to tail off, but I think we can now say that this will probably, it's unlikely that we're going to come back to this zone here at around $18,000 low, or 18,000 point low with this low volume. The same thing for the S&P 500. It seems unlikely that we're going to get back to this area, 52, 53 that we're looking at to fill in the gap of the low volume, because we saw such significant volume on the way down and huge buying here. So I think we have, well, at least what I'm following now is pivoting into that COVID style rise, because we're seeing a similar style recovery to what we saw about 5 years ago. And the last one here is the Dow Jones, same sort of thing, big dump, higher low, broken past 50%, broken past the downtrend. And the only thing the Dow Jones hasn't done is broken past that May swing top, like what the NASDAQ and the S&P have done. So overall, there is still a lot of strength in the background for the stock markets, even if there are some corrections, even if there is going to be some time out here to consolidate the move, even if the volume remains relatively low at this stage. It seems similar to what has happened already in COVID. The same deal goes for the curve lines that we're using. This is basically the predictive cycles looking out to our Q3. The 10 and the 20-year cycles looking back to 2005 and 2015 also show the grind out through to Q2 and then into Q3 before we get that correction into August. Now, it looks severe on the chart here, but in those years, they didn't have the severe correction earlier in the year, around that March-April period. So that's why, even though it looks severe here, I would still anticipate some sort of correction, but probably not as severe as what the cycle is showing. Now, another thing which is repeating like previous cycles is the US dollar. This may be putting a little bit of pressure on assets like BTC now. Obviously, we saw the correction on BTC. US dollar is up and popped in the last 24 hours. So on the daily chart here, you can see it broke back past 100, 101, and had a strong close there with some volume coming back into the space. 1.4% up for the USD. Now, back to the monthly chart, and it's the same thing that we've been tracking. Roughly every time it breaks to a new 3-year low, we've seen a pause on the price, basically some consolidation. And the two previous times, which I guess could be a little worrying for some, is that we saw a significant rally from that low back to fresh highs. Again, from that low, took a few months. This was a big boom to the upside. The difference here is that it has broken down from the highs. Yes, we need to wait for the monthly close to get further confirmation, but we also have some increased volume on the down months here and our 3 months down as well. So provided this continues to consolidate here, close underneath roughly around 100, that's going to lend its hand to dropping off sooner, potentially giving more of that rise to BTC. So in terms of Bitcoin and the crypto data that we've been tracking, just a little drop off here in the last 24 hours. Overall trends are still up for the search volume, Bitcoin crypto, of course. So that's a good sign there for the overall space. The exchange volume also, now we've got a confirmed higher high and higher low on the exchange volume. So more retail money coming into the space. Now, even if this is a pause for Bitcoin, a pause at this high here, that's okay. We're starting to see some of the signs of the market coming back, some of the retail coming back, and it would only be natural to at least consolidate the move and maybe even just do a shallow correction into your 96s or 92 lows there. That is similar around the 50% level there at 92 and those previous lows. Sure, it can go further, but let's just worry about the next support levels to the downside first. Now, that was the exchange volume, so that's also turning around. So they're good signs there. The liquidations also wiping out some of the longs. It did get a little bit frothy there over the last few days. We had the shorts get wiped out. We had the longs get wiped out. And the 24-hour volume was very close to $750 million in the last 24 hours. So another good thing there, just to wipe out the frothiness so we can get a consolidation and a move higher yet again. Now, another interesting chart that I follow time to time, it doesn't make up the core of my trading plan, but I do like to see whether this is showing some confluence with the other signals out there, as it's a representation of the commitment of traders. Where are the speculators positioning themselves? In the blue, you've got the large speculators. In the yellow, you've got the small speculators. And in the red, you've got the commercials. So you generally want to be on the side of the commercials and doing the opposite of the large speculators. As I said, this is not a standalone system, but just so that we can get an idea of where the speculators are heading, you can see the commercials have been rising, the large speculators have been falling, so going short, and of course the markets have been going up. So just in this recent example, basically want to be on the side of the commercials rather than the large speculators here. Now, the total crypto market cap is also playing out in a similar fashion to what Bitcoin has been doing, obviously at a slightly lower price point here, and the structure is slightly less bullish than BTC because this has Ethereum, altcoins, stablecoins in it as well, but it's still looking much stronger than the total 3 market cap, which is your altcoin market cap. This one here, we've broken past 50% and just hit our head on the 200% extension of the first range out. So a nice little area to find some resistance. Ideally, consolidation above $3 trillion is going to be a good setup for that next leg out for altcoins. And because it's total crypto market cap, altcoin and BTC. So it could take a little time here. Now, the thing that could all bring this undone, basically it could make or break the entire game, is the USDT dominance. I've got a fractal on it, again, similar, well, it's the same fractal from what happened at the peak of 2021. You can see the peak of BTC here in the orange. This is USDT dominance. For the dominance, you want to keep seeing it break key support levels. It needs to keep breaking down. Now, I've got, as I said, the red fractal here, and it's the same as what was back in 2021. We saw Bitcoin rise into a new all-time high, but the USDT dominance was unable to break past the previous support area. And you can see we've got a couple of support areas now firmly between 3.7% and, for a round number, let's call it 4.5%, 4.4, 4.5. Same deal happened at this peak here. So this was the March top, lines up very much with the low for the USDT dominance. So that's there at 3.7, again to 4.5. And this previous top that we just have worked ourselves through, that was the top there, basically what Bitcoin, $90,000 to $108,000. So this is where you would want to run for the hills, is if we keep seeing Bitcoin climbing higher, maybe Ethereum's climbing, maybe alts are climbing. This is just to paint the picture in the background there. People are going nuts. They're bull posting on X, getting a little bit crazy. You know, you're not bullish enough. 200K is the next target, all this sort of BS. And the USDT dominance is not able to break this zone, or it's holding out and starting to put in a pattern like what it did last time, because, well, it's done that one. It did that pretty similarly here. It was a little bit of a shorter time, but it did put in a support, tested it, bounced up, tested it, and then started to break higher, which is obviously led to the dump, and especially a big dump for ETH and altcoins. So over the coming months leading into this sort of, early Q3 perhaps, USDT dominance is still, if it's still not breaking through the zone of 3.7 to 4.5, probably a good sign to get a little cautious on your trades and not to get a bit too crazy like the bull tards. The reason for that is this is where the money is in crypto. Well, this is like our global money supply for Bitcoin. And if it's not getting projected out there, if it's not being released, well, then where is the money coming from? Some might say, well, it's just ETF buying, and that goes straight from cold hard USD into ETFs, into Bitcoin ETFs perhaps. This has had such a strong correlation between the two, it would seem unwise to forget about it. And yes, I already hear the argument saying, well, just because it's correlated doesn't mean it has to continue on like that, for sure. But while it's still working, probably a good idea to keep it there and working pretty damn well. Now, the other one I take a look at is USDT dominance plus USDC dominance. So the two largest stablecoins basically making up over $200 billion in the space, I believe, if I'm not mistaken. Anywho, you're back down here at the double bottom of 5%. So this chart also should be able to break down from the 5% level if we're going to see some pretty significant gains for Bitcoin, ETH, and so on. Now, you might have Bitcoin breaking out, showing some strength here, especially on total 3. But you might not see the breakout for ETH or some of the other major altcoins. And that's what could lead to a grind out for the stablecoin dominance. So you might see some of the money flowing into Bitcoin, but not to the rest of them, which then means you've got this bit of a traffic jam here between 5 and 6% over the coming months. But if this breaks down, then basically everything is different. We finally get a breakdown and it doesn't repeat what it did in previous cycles, basically giving you a bit more of the bull market for a period of time, putting in another base, and then taking it all back pretty damn quickly. So because we're leading into these final waves into a peak, at least that's my opinion, I still think it's important to be cautious, but there are still plenty of examples of altcoins popping off. I posted about a few of those to members. That's TIA Premium. There's a link in the top of the video description looking at Dog with Hat even just a few days ago. One of the members wasn't watching it, but that's the whole point of the community there. You can see what everyone else is doing or at least posting about. And Psych has made some pretty significant trades, just keeping an eye on a few of these coins that we've been tracking now. So I must admit, not following anymore. Good pickup, 390% off this trade, 100% off this trade. Congratulations, really, really good stuff here. So taking it back to Bitcoin now for the sort of what we've seen before, this repeat of a pattern, the fractal that I've got on BTC here is from 2007's bull market. So it goes back to some of these moves in middle of the year. So we had the correction and then a fast run out. So what I was looking for was a correction and then that quick move out of those lows. Now it's not going to be exact, of course, but the idea is just to see what has happened in the past after a severe correction. Does it hold out? And then start to follow a little bit of the fractal, provided the trade or the technical analysis that I use, because of course this is for my own trading strategies, that is also being mirrored in the signals itself. So if my swing chart is also holding up, the 50% level is holding up, yes, tick box, yes, tick box. So let's see whether it continues to follow a similar path here. Now there's an Elliott wave update on Michael's channel. I'll leave a link to that in the video description. Go and check that out. It's looking at the final 2 waves into the peak. Now the video is not complete unless I have another look at Ethereum. A few days have topped out here at around $2,600. Just a couple of $100 short now of the 50% level, 2,745. Ideally, that's where ETH gets to then consolidate and then test that $3,000 and $4,000 level again. Otherwise, this is all a bit of a abnormal pump, as ETH often likes to do. You can see it happen in November, basically led to that final peak. We've seen it in the past before, leading into that final run up. So there are pretty sizable moves here, $23,000 to $4,000. But in each of the occasions now for this bull market on ETH, it's essentially been a trader's game. Big moves to the upside, correction, another big move to the upside, correction, big move, correction, and it's just continuing to rinse and repeat. So rather than it be a holder's market and this thing blow up to 20,000, of course anything's possible, this cycle so far has proven to be a trader's market for ETH. Just what has actually happened, not the hopes and the dreams of the hopium bulltards that have continued to tell us that things are going to go to $20,000. Of course, there is for my viewers that are the up, down, sideways friends, there is the possibility of the upside, but it has to break $4,000. You got the triple top, 1, 2, 3. If this is able to come back, find support, and then test that again, that is where I'd be getting very excited that we could break through and actually send it much, much, much higher. Be looking at some extensions of major ranges here. But at the moment, it's still got that triple top in play. It's coming up to test the 50% level at 2,700. Now, in terms of strength, as I'm filming, there goes XRP back down. It had put in a close above the 50% level, $2.50, $2.51, breaking past the 50% extension and the 50% of the downtrend. So that was looking okay. But as we always say, it needs a couple of, I look for 3 days, 3 closes above those levels. Otherwise, one day can be short-lived. For now, at least, very short term here, we're seeing a correction back underneath both levels, $2.44 as I'm filming this. But it's still on my list of stronger alts to watch because of the overall pattern and structure being above the 50% and also holding higher lows as well. Like, subscribe. The report is coming out in less than 12 hours. For other trades, check it out, TIAA Premium link. Now, we're also discussing what we're doing leading into the peak and coming out of the peak with the community, and other members are also putting together their game plans for their long-term investing. Hopefully you guys can join us there. Otherwise, I'll see you back here at the next video. Till then, take care. Peace out.